I'm Daniel.
And I'm Mira.
And wow, if you spent today staring at your trading terminal, you honestly probably need a neck brace.
Oh, absolutely. The whiplash was real.
Yeah, it really was. Today is Friday, June 26, 2026, and the intraday swings we just lived through were, well, they were just absolutely extreme.
It's exhausting just to watch, right?
Exactly. We saw the S&P 500 swing nearly 100 points today. It bounced wildly all over the place before basically closing totally flat at 7,354.02.
Which is crazy when you look at the NASDAQ.
Right. The NASDAQ just took an absolute beating from its morning highs. It closed way down at 29,300. But then on the flip side, you have gold surging over 100 points off its lows, closing at a massive 4,094.80.
Yeah, we're basically looking at a market that is caught in this really violent tug of war right now.
A tug of war is the perfect way to put it. And that's exactly our mission for this deep dive today. We're going to unpack the underlying forces driving these massive market swings for you.
Right, because on one side of this rope, you have these resurfacing geopolitical tail risks that are absolutely blowing up the Strait of Hormuz.
And then on the other end, pulling just as hard, you have this hawkish Federal Reserve. And they're now explicitly pointing to the massive AI buildout as a major driver of inflation.
Which is a huge narrative shift.
It really is. So today we're going to figure out the fundamental logic behind the moves you saw and see how the tech sector is basically getting squeezed from multiple sides.
And, just a quick disclaimer before we really jump in here. This deep dive is for market context and discussion only. We're just here to help you understand the baseline you're operating against.
Right. Definitely not personal investment advice or, an investment recommendation.
Exactly.
So let's just wind the clock back a little bit. Session 1. What set the stage before the U.S. session today?
Well, U.S. traders basically woke up to a massive geopolitical fracture. At 7:01 a.m. Eastern Time, these reports hit the wire that the U.S.-Iran interim ceasefire in the Strait of Hormuz had, it essentially collapsed.
Oh, wow. So just totally broken down.
Yeah, completely. Overnight, Iran actually fired attack drones at commercial vessels traversing the strait. And the response was pretty much immediate. U.S. forces launched retaliatory strikes on Iranian coastal radar and their drone storage facilities.
And there were explosions reported, right?
Yeah. Significant explosions reported in Iran's southern Syriac region.
It's so tempting for the market to treat these geopolitical flare-ups like unpredictable natural disasters, just this random lightning strike of risk that you can't possibly model for.
Right, exactly.
But we really need to challenge that reflex, I think. If you look at this through a game theoretic lens, this is classic geopolitical brinkmanship as bargaining leverage.
Oh, for sure. They're testing the waters.
Exactly. Iran isn't just lashing out randomly here. They are aggressively testing the boundaries of the interim ceasefire to see exactly how much they can squeeze those global shipping lanes, before Washington just walks away from the negotiating table entirely.
Which is just an incredibly dangerous game to play with global supply chains. I mean, that calculated stress test completely shattered the relief rally we saw earlier in the week.
It wiped it out completely.
Right, because by violating the ceasefire, a severe geopolitical risk premium has just been violently injected right back into crude oil.
Yeah, because when drones are flying over commercial vessels, shipping insurance premiums just skyrocket. Tankers have to be totally rerouted.
And the market instantly prices in a massive supply crunch. That's exactly why crude bounced so wildly today.
And the instability wasn't just isolated to the Strait of Hormuz either. We also had these major, albeit kind of confusing, developments in the Levant. Just a few minutes later at 7:20 a.m. Eastern Time, news broke about a U.S. brokered trilateral framework agreement.
The one signed in Washington, right, between Israel and Lebanon.
Yeah, exactly. And, on paper, this is supposed to be a massive de-escalation. It's designed to restore Lebanese sovereignty, disarm Hezbollah, and supposedly allow the Israeli military operational freedom in a designated security zone.
Right. But the market is treating that piece of paper as incredibly fragile, and honestly, for good reason.
Why is that?
Well, almost the second the ink was dry in Washington, a Hezbollah lawmaker went on television and completely rejected the framework, totally vowed to confront the measures and retain all their weapons.
Wow, so there's a huge disconnect there.
A massive one. You have this diplomatic progress being made in conference rooms, but the market is pricing in an immediate failure on the ground. Like, a treaty doesn't mean much to oil futures if the paramilitaries on the ground refuse to actually drop their rifles.
That makes total sense. And to add to that exact cognitive dissonance, we had some really highly conflicting signals regarding the broader nuclear negotiations, too.
Oh, right, from the IAEA?
Yeah. Much earlier in the day, around 12:21 a.m. Eastern Time, IAEA Chief Rafael Grossi announced that an, quote, undeniable consensus had been reached to begin verifying Iran's nuclear facilities.
Which just creates incredibly muddy waters for traders. You have this institutional verification process inching forward diplomatically, while simultaneously radar stations are literally being blown up.
Yeah, it's hard to reconcile those two things.
Exactly. When the military situation deteriorates that fast, the market naturally just ignores the diplomatic consensus.
It's all about what's actually tangible. And speaking of tangible, let's look at the macroeconomic reality that dropped right before the opening bell. Because this is really what set up the afternoon's carnage.
The trade data.
Right. At 8:30 a.m. Eastern Time, the U.S. advanced goods trade balance deficit widened dramatically to $105.8 billion.
Wow. And the forecast was what, like 85?
Yeah, an $85 billion deficit forecast, so they completely missed it.
That is a massive miss. When the trade deficit widens that dramatically, it basically tells you that domestic demand is pulling in imports at a frantic pace, or, exports are just stalling out completely.
Which is a huge drag on overall GDP calculations.
Yeah, it is. But honestly, the more concerning element for the Federal Reserve came from the consumer side of things today. The final June University of Michigan sentiment reading came in at a deeply pessimistic 49.5.
People feel terrible about the economy right now, even if the stock market has, generally been hovering near highs.
Right. Main Street and Wall Street are totally disconnected.
Exactly. And the reason they feel terrible is totally embedded in the next data point. Those sticky one-year inflation expectations, they're holding absolutely firm at 4.6%.
Which is basically a nightmare for the Fed. If consumers expect inflation to stay high at 4.6%, it changes their purchasing behavior, right? It changes their wage demands. It makes inflation this self-fulfilling prophecy.
It really does. So just pulling all of this together, U.S. traders walked into a tape today defined by flaring Middle East tensions, a totally shattered ceasefire, and a distinctly stagflationary-leaning data print.
Yeah, a widening deficit combined with a gloomy, inflation-battered consumer, that is a historically tough baseline to treat against.
It's a brutal setup, so we'll take a quick breath here. Because that sticky inflation data from the morning perfectly set the trap for the afternoon, which brings us to session 2. What moved markets during U.S. trading hours today?
Well, the single biggest narrative shift of the day arrived right before lunch. At 11:29 a.m. Eastern Time, Minneapolis Fed President Neel Kashkari stepped up to the microphone and delivered some shockingly hawkish remarks.
Really hawkish.
Yeah, he didn't just talk about generic inflation either. He explicitly stated that the massive AI data center buildout is acting as a primary driver of inflation.
Wow.
Yeah, he said it's actively pushing up market interest rates. He even floated the idea that the Fed might actually have to resume rate hikes this year just to cool things down.
I want to pause and really unpack this because this is massive for anyone holding like a tech-heavy portfolio right now.
Oh, for sure.
Because for the last year, the market has basically celebrated the AI capex supercycle purely as a growth story, right? Buy the chips, build the sprawling data centers, and eventually you reap the future productivity profits.
That was the whole narrative.
But we really need to look at the mechanics of how this actually creates inflation in the real world. Think about it like a massive new factory town being built overnight.
That is the perfect way to look at it.
Right. These mega-cap tech companies are pouring hundreds of billions of dollars into physical infrastructure. They're buying up massive plots of land. They're literally draining local utility grids of power and water just to keep these servers cool.
And they're outbidding everyone for specialized labor, too.
Exactly. When you build a giant factory town that quickly, you accidentally price out all the local residents. You strain the copper markets, you strain the energy grid, and you just force the cost of raw materials up for every other sector in the economy.
And that is exactly what Kashkari is pointing out. This capital expenditure is so aggressively large that it's creating a self-reinforcing inflation spiral. And here is the brutal irony for tech investors. If the success of AI means a permanently higher cost of capital because it's soaking up so much power and resources, then tech multiples inevitably have to compress.
Right, because of discount rates.
Exactly. We know that discount rates act as financial gravity. When the rent on money goes up, the present value of those distant future AI profits just comes crashing down.
And tech multiples weren't just being squeezed by the Fed's financial gravity today either. They were taking direct hits from regulators as well. We had two major regulatory stories really punishing the tape.
Oh, yeah, the OpenAI news.
Yeah. First, late yesterday, so Thursday, at 4:13 p.m. Eastern Time, news broke that the U.S. government actually pressured OpenAI to stagger its GPT 5.6 rollout. And they essentially forced them to reconsider their IPO timeline.
That is an incredibly heavy-handed intervention. It really shows that the government is getting deeply anxious about the deployment speed of these frontier models. They're likely acting out of fear that the capabilities are outstripping the safety frameworks.
Yeah, and when the government starts dictating product timelines, it puts a really hard ceiling on immediate revenue growth.
It absolutely does.
Then at 12:01 p.m. Eastern Time today, Donald Trump threw a massive wrench into global tech revenues. He threatened immediate 100% punitive tariffs on any country that imposes a digital services tax.
Right, and a digital services tax is basically foreign governments trying to get a cut of the massive revenues that U.S. tech giants generate within their borders.
Exactly. Trump is aiming to shield those U.S. mega-cap tech companies from foreign taxation. But the immediate response from the European Union was a promise to retaliate decisively.
Which just risks setting off a full-blown global trade war. And trade wars compress margins, they disrupt supply chains, and they create exactly the kind of uncertainty that makes investors dump high multiple growth stocks.
Now, I do want to push back a little bit on the mainstream financial news narrative we saw circulating this afternoon, because a lot of the headlines were claiming that Kashkari's hawkish comments, quote unquote, plunged the NASDAQ.
Yeah, they were very dramatic.
But if you actually pull up the 15-minute tape data, that explanation is just way too neat, and the timing is completely off.
You're right. The timing doesn't reflect a panic sell-off at all.
Right. Kashkari spoke around 11:30 a.m. Eastern. But at 1 p.m. Eastern Time, a full hour and a half after his comments hit the wire, the NASDAQ was actually holding strong around 25,433. It didn't fall off a cliff the moment he said the word hike.
So what actually happened then?
What we actually saw was a slow, agonizing, choppy drift into the close, ending down just 0.2%. The reaction wasn't a sudden plunge. It was a slow, methodical repricing of duration risk as institutional managers digested the reality of higher for longer capital costs.
Yeah, it was a bleed, not a crash. And while tech was bleeding out slowly, gold was the absolute clearest winner of the day's uncertainty. I mean, it rallied incredibly hard into the close, jumping over 100 points.
This is a massive move.
It really proves that when duration risk rises on the tech side and geopolitical tail risks just explode in the Middle East, the flight to safety is still a very real, very powerful market reflex.
Yeah, definitely. So, given that slow bleed in tech and the massive flight to gold, let's take a quick pause. Moving into session 3 for our corporate events recap and what to watch next, what else stood out?
Well, looking at sovereign debt, at 4, 5, or 8 p.m. Eastern Time, S&P affirmed the U.S. sovereign credit rating at AA plus A1 plus with a stable outlook.
Okay, that sounds pretty reassuring on the surface.
It does sound reassuring, but if you read the actual report, they included a pretty stark warning in there. They noted that net government debt is rapidly approaching 100% of GDP, and that's being driven almost entirely by structural interest payments and the aging costs of the population.
Wow. Which means the government is spending an absolute fortune just to service the debt it already has.
Exactly.
But, that doesn't seem to be stopping sovereign spending at all, especially when it overlaps with technology. Late Thursday evening, around 5:13 p.m. Eastern Time, we saw reports that South Korea is procuring a staggering 110,000 military drones.
110,000.
Yeah. And at the exact same time, the U.S. Pentagon is actively expanding its use of AI in target selection.
This is such a crucial distinction for listeners trying to figure out where the money is actually flowing right now, because this perfectly illustrates AI capex as a cycle-agnostic arms race.
What do you mean by cycle-agnostic?
Well, it's not just Google and Microsoft building data centers for consumer chatbots anymore. Sovereign governments are pouring billions upon billions into militarized AI and autonomous hardware, completely regardless of where interest rates sit. The geopolitical tension we talked about in session 1 ensures that defense spending isn't going to slow down just because borrowing costs are high.
That is a really great point. Oh, and before we move on, I should briefly mention that at 10:41 a.m. Eastern Time today, Iraq began pushing for OPEC quota reassessments to allow them to produce more oil.
Oh, okay.
It's a relatively minor background headwind for crude prices, especially compared to the drone strikes. But it's definitely worth noting as OPEC's internal cohesion gets tested by countries needing more domestic revenue.
It is all just connected in this bizarre web of risk right now. If your portfolio felt like it got hit by a one-way drone today.
Don't worry, the Pentagon probably just used their new AI target selection on your tech stocks.
Exactly. Oh, man, that's dark. But it was a wild ride out there, with crude bouncing around more than an AI startup dodging the government.
It's true.
But look on the bright side, Neel Kashkari just confirmed the AI supercycle is going to make absolutely everything more expensive, including the cost of drowning your market sorrows this weekend. So grab a drink before the Fed hikes again, and let's just hope the only thing crashing tomorrow is us on our couches.
Honestly, I think everyone trading today needs that drink. But the market doesn't sleep for long. Looking ahead to the next 24 hours at Catalysts, we have a few key data points to watch.
What's on the docket?
Sunday night at 11:50 p.m. Eastern Time, we have a speech from Fed's Barkin. We'll have to see if he echoes Kashkari's hawkishness.
That'll be a big tell.
Yeah. Then Monday morning kicks off early with a Bank of England speech from Pill at 5 a.m. Eastern. We get Spain's preliminary CPI at 7 a.m. Eastern, followed by a whole bundle of euro area sentiment data at 9 a.m. Finally, Monday afternoon at 2:30 p.m. Eastern Time, we get the U.S. Dallas Fed Manufacturing Index alongside some standard Treasury bill auctions.